So we're gonna be going over how to read stock candlesticks, and what better way to learn from somebody that's been trading stock candlesticks since he knew how to fucking drive. All right, so every single day there is a constant struggle between buyers and sellers, okay? And that lends to individuals making fees off trades and individuals making profit off actual trades themselves. So there's a constant flow of money being exchanged between individuals and banks, okay? So the reason why I'm making this video also is because when I've asked a family member, you know, what am I looking at on my screen? Can you tell which way the stock is going? Can you tell which way, you know, is this a choppy or is this, you know, a market that is going in one direction? Is it choppy or is it going in one direction? What is it? So we're gonna be talking about how to read a candlestick, all right? So the reason why this isn't green is because I don't have a green marker. The green marker that I have is all dried out. So green is our purple. Obviously, when you're actually trading, your candlesticks can be any color that you want. So sometimes traders don't like to trade with green and red because it messes with their psychology too much, their emotions, so they trade with different colors. So just for right now, this is green and this is a red candle, okay? Now we're gonna be going over what is the definitions of a candlestick right here. So right here it's called the wick. That is a wick. That is a wick. I'm gonna be explaining what the wick is here shortly. And this is the body of a candlestick, okay? Oh, that shit's a little fucked, whatever. Doesn't matter, I don't have to be perfect, but you guys can come to conclusion. This is the body of the candle, and this is the wick of the candle, okay? Now, I'm gonna ask you a question. How would you read a red candlestick, okay? Think about it yourself, and then now I'm gonna go over it, okay? So, a red candlestick, this is where we opened, okay? And this is where we closed, okay? So right here is where we opened, and this is where we closed. What are these wicks, and what do they mean? So, for a red candle, we opened up here, we pushed as high as the top of this wick, but then we closed down here, and we pushed as low as this wick, but came back up and closed. That is what wicks are, and they're just showing you how high the stock price went before it closed and opened, okay? Now, for the green candle, a candle that's going up, a bullish candle, this is a bearish candle. So those are the two definitions, bearish, bullish candle, okay? This candle opened here, went as low as right here, but then we ended up closing here, but went as high as right here, okay? So this is the open and this is the close, okay? So for a bullish candle, this is the open, this one is the close, all right? For a bearish candle, this is the open, and then this is the close, okay? So now that you know how to read a candlestick, we're gonna be going over the different types of candlesticks that you should be looking out for, okay? So this is a bullish engulfing candle. When you see, sorry for the clearing my throat, but when you see a bullish engulfing candle, you would expect that this would go on longer, like there would be another green candle following this candle. Same thing as a bearish candle. If you saw that big bearish candle, you would assume that there's going to be continuation after that candle. Think about stocks like this. If you see somebody throw a football, okay? He throws a football. The harder he throws that football, the farther it's gonna go. So a candlestick, the bigger the candle, the harder the stock is falling. So eventually, when the power runs out of the throw, the ball will eventually start falling down. That's the same thing as stocks. If a stock pushes down in one direction, it will slowly turn back around and you will get these doji candles. Okay, now what is this candlestick telling you? This candlestick is telling you that sellers are in control, and that there could be some more downside. This is sellers are in control. This is bullish engulfing. Same thing as bearish. If you see this candle, you would expect for it to go bullish some more, a continuation. And if you see this candle engulfing other candles, that there's some volume into that trade. Okay, so buyers are in control here, sellers are in control. Now, what do you think about this candle? This is a bullish candle. Okay, if you saw a bullish candle, this candle after this candle, you could think, oh, okay, this could be a good position to put some risk on, maybe put a light size, and if we continue going up, then you can add on to that. Okay, so these are nice doji, a pin bar, a nice doji pin bar. So this candle, nobody's in control. This could be green or red, depending on whatever's happening in the market. But this is telling you that buyers and sellers had a struggle, and that nobody won. It's just a fight between bears and bulls. Nobody won though. And you could go for the same thing as this one, but you got to think about it in context of what's happening. If you just see a bunch of these candles that are chopping around, nothing's happening, you don't want to be in that. But if you see a large move down to the downside, and then you see some doji candles happening, a nice pin bar, then you're going to be wanting to get into that trade. So I hope this helped going over how to read candlesticks. I know it wasn't perfect, but I can also make another video more detailed about this in the future. We're going to move on now to a theory that I like to use, and that's been used over 100 years. Okay. So what is this theory? And the theory we're going to be talking about is called the Dow theory. All right, this theory has been around over 100 years. All right, the Dow theory. And the Dow theory is an approach to trading developed by Charles Dow, who, with Edward Jones and Charles Bergstresser, founded the Dow Jones and Company Incorporated and developed the Dow Jones Industrial Average in 1896. Dow fleshed out the theory in a series of editorials in the Wall Street Journal, which he co-founded. And what is the one thing I want you to take away from the Dow theory? Okay, there's one thing I want you to take away from it. There's a couple of different phases in the Dow theory, but this is what I want you to take from it. An upward trend in Dow theory is a series of successfully higher peaks and troughs, and a downward trend is a series of successfully lower peaks and troughs. What does this mean? What should an uptrend look like? An uptrend, and what should a downtrend look like? Okay. Now, you're going to want to see a downtrend continue to make higher highs and higher lows. Okay. So this is a higher high, a higher low, and once again we made a higher high, and then we made a higher low, and that's an uptrend according to the Dow theory. And this is something that I would use on a daily basis to understand if we're in an uptrend or a downtrend. Okay. Now we're going to be going over a downtrend. They're going to be making lower lows and higher lows. Okay. So right here, we made a lower low, and then we also made a higher low. Then we went to make a lower low from the past low, and then we made a higher low from the past high, okay? Now that is a Dow theory. Use that to your advantage. It's been around for 100 years and will tell you if a stock is in a downtrend or an uptrend, okay? Now I'm gonna be going over a couple different scenarios that go on during trading and how you can profit off using the Dow theory and some of these examples. First, we're gonna be going over a bounce, okay? So, a bounce trade. Now, this trade is gonna come in when sellers are exhausted and buyers are stepping back into the trade, and then you can step in and make a profit on the upside, okay? So, what you're gonna see is, let's just say we got a little bearish engulfing to the downside, and then, you know, we had like another little doji candle here, and then you see we have here a nice pin bar candle, okay? So, and we're coming into a demand level, levels where the stock has bounced from before that you know that buyers are gonna be at, okay? So let's just say we have a level here as well that is holding well, okay? Now you see this doji candle here. You see that now sellers are exhausted and buyers are coming back into the trade. Now this is where you're gonna wanna take an entry for a position on your stock, whether it's gonna be calls, you're buying equity, whatever it's gonna be, this is where you're gonna wanna set a nice position. And if we were to break lows, you would exit. But if it were to hold, you know, hold your position. If we broke highs up over here, you could say, oh, I want to take some money off and, you know, just let my runners run. And then you'd be trading with just profits now, because you probably made enough money from here to here to just leave a runner and just be risk free. Okay. And what would you, and the way you would use the Dow theory is the fact that, you know, we come down here, we're making this low, and then yet we have another candle that doesn't break the lows here. We hold right here, and then if we continue holding up this way, then you know that you're in a short-term uptrend and that you can make some money off of. This is a very short-term play. There's obviously ways that you can use the Dow theory for longer-term plays, but I'm just showing you a very short-term intraday trade that you can make money off of, okay? That I use in real life, okay? So now I'm gonna be going over a reject, okay? A reject. Okay? Now this one, buyers are pushing up into supply, okay? And we also had a reject from this level the previous day, okay? That goes with the Dow theory. So, the Dow theory states we had a reject the previous day, that if we break this, then we would create a higher high. But instead, we had a bullish candle, and then we pushed into supply where we reject the day before. This is gonna be your entry to join the smart money and maybe make some quick money to the downside, okay? So your entry would be right here for some puts or to short some equity, and then that's how you could make money off a reject, all right? Also using, you know, the Dow theory. Once again, you know, we have to continue pushing down here. So we push down here and we pop back up to this supply. As long as we don't break high and push back down again, that's your sign to stay into the trade. Use the Dow theory to your advantage and let's make some money, okay? Now, I got one more quick scenario that's gonna help some people make some money and avoid some crazy economicness, the economic data that comes out. All right, so now I'm going to be going over a trade here that you could use during economic data that comes out around 10 o'clock, 10:30. That could shift the day, change the market, and the market could choose a direction after this time. So usually we can have a trade, okay, it's right here, and we're holding down here. We have some candles here, got a little doji candle, and we got a little doji candle, but we start to push back up over here during economic data release, whether it's crude oil reports, whether it's new housing sales, whatever it is that's gonna push this stock up, okay? So news comes in and you see the stock immediately. So let's say immediately push up, okay? And you see it wick, create a new low, but we had a quick push back up, okay? Where buyers came in and bought the stock back up. That is an ideal area for position. Even though we broke lows, buyers are there for you to stay in this trade, and then it continued pushing up. And then your idea would be, okay, as long as we don't break this new low with the Dow theory, we can come down here, you know, and go back up, come back down, go back up, and that's how you would make some money on that trade. But I suggest that you go light into this position as you're trading with economic data, and that is very risky and can lead to you losing a lot of money. Remember, this is all not financial advice. This is just a way to help you maybe make some extra money on the side, all right? And actually, this is gonna lead you on the right path of trading. I'm not gonna teach you some shitty strategy or stuff that doesn't work anymore. And I'm not some boomer that hasn't been looking at charts and just believes in long-term investing. An individual that believes if you become very good at something in this world, you can attract large amounts of wealth and create your own reality, okay? You can even go back and look at my past videos, okay? All right, there we go with that. All right, so now we're gonna be talking about how to be successful in 2025 trading, okay? How to be successful in 2025. The first thing you need to do, all right? The first thing you need to be doing, one, find a mentor. There's plenty of people online that you can look up to for trading, any advice you need, whether it's options, long-term investing, futures, trading futures, fast paced, whatever it is, find a mentor that's doing it, that you like their trading style, and stick with them. Two, okay, find a trading group. Not only can you find a mentor, but you also can find a pod to trade with. Find a group of individuals that trade like you, who you could take advice from, learn with, make mistakes with, and also make money with. So find a group, find a pod. Number three is not letting mistakes affect you. Okay? Not letting mistakes affect you. Whether it's making a stupid decision in the morning, that's gonna lead you onto a red day, that's gonna make you continuously taking stupid trades after that. You need to realize when to stop. Also, at a certain point in your trading career, when you make a certain amount of money, you will then be in against the battle of your emotions and psychology. whether it's losing thousands of dollars and not being able to trade again. How are you going to fix your mindset if you wake up one day and you lose half your portfolio of a stupid decision? Are you going to be able to get back up and trade the next day? I doubt it. You might be able to get back on and lose a couple more $1,000 trying to make back the money that you lost. Okay, so not letting your mistakes affect you, having the correct mindset when in the losing position, having the correct mindset when in a winning position, having a correct mindset of not being too desired for money. You need to have the mindset of already a successful trader, an individual that does not need a trade, an individual that takes trades that are only up to his standards, okay? Number 4 is don't tell people what you're doing, just enjoy the fruits of your labor. Others will not understand you or trading. Don't tell anybody. The more you tell people, the more people that are going to shoot you down. Most individuals have so many misconceptions about trading, either that trading's too hard or that trading is easy for that individual but hard for me because it's just straight up for them. No, trading is never straight up. Trading has many different psychological problems, many different drawdowns with financial problems, so many different things, and you need to be able to take this journey and just laugh at it and continue pushing on and pushing for your dreams of becoming a successful trader, even just becoming a successful person, learning about how you think emotionally in situations. Emotional intelligence is what's going to help you push yourself above the curve of everybody else, okay? Also, I can't stress this enough. Please find a pod. Please find a mentor if you're looking to trade. And also, everybody's not going to understand what you're trying to achieve. They honestly probably don't even understand trading at all. So once again, keep it to yourself. Push on, team, and let's get it.